Good morning. You are watching a live daily market outlook for Tuesday, 1st of May 2012. We're at the beginning of the new month with the highlights of the previous 24 hours and especially the overnight session being the overall weakness of the dollar due on the weakening data that are showing that U.S. economy's recovery is again slowing down, and more significant is surprise rate cut from Australian Central Bank that came out of a cut of 0.5% instead of well expected 0.25%. The Australia's central bank said cut interest rates by surprisingly aggressive 0.5 point the overnight, and said inflation would likely be lower than expected for the next 2 years, leaving the door open for a further easing if needed. This caused immediate slump of the Aussie dollar against the US dollar that fell around 0.75%, and the government bond yields hit 60 years low as the Reserve Bank of Australia cut its cash rate set by surprisingly 0.5 point to 3.75 from 4.25 against expected quarter cut from 4.25 to 4% level not seen since late 2012. The markets had predicted only a quarter point easing, and this was quite surprising. Driving the larger move was the need to get mortgage rates down to stimulative levels, given local banks have been nudging up their rates to cover higher funding costs. A move had been widely expected given a background of benign inflation and disappointing economic growth. From China, also the surprising release of the China's official purchasing managers index that rose to a 13-month high in April, signaling the economy has found a footing and might be recovering for a first quarter through, but smaller factories are still struggling. The pickup in the PMI to 53.3 from 53.1 in March indicated further expansion in the West factory sector, although it was slightly below market expectations of 53.6. However, a reading above 50 signal expansion in the economy, while those below 50 points are signaling contraction. The manufacturing output sub-index rose to 57.2 from 55.2 in March. However, the National Bureau of Statistics of China noted that many important industries remained weak, with index reading below 50 among them with the chemicals, equipment, automobiles, and the oil refining. The improvement in manufacturing likely reflected restocking after a slow winter. As economists said, also the infrastructure investments was recovering as the dust settled from a corruption scandal in the Ministry of Railroads and from a bureaucratic reshuffling of the local government level. The major currencies, the euro remains well supported after finding support yesterday at 132 zone, and currently holding around, consolidating around the 132.50. However, still holding below our key barrier at 133.00. The sterling is at the back foot in the near term price action after touching yesterday our upside target at 163.00, currently holding around 162.15 Fibonacci support, with the potential of further corrective action seen in the near future as rather negative near-term studies keep the still downside in focus. The dollar yen continues to trend south with yesterday's loss of 80.00 handle, now heading towards our next target 79.50, pardon, and 79.00, while dollar against Swiss franc is also losing ground, and currently at 90.60 zone, with the focus at our next strong support at 90.00. Commodities remain supported for now as oil holds just under levels of $105 per barrel, consolidating the recent gains, while gold is also hovering around the 1660 zone after hitting yesterday's high at 1667.90. Overall positive tone on commodities is seen by a weakening dollar, as mentioned at the beginning, and quite negative output from U.S. recent data that are showing again slowdown in the U.S. economy's recovery. From Japan, comments about strengthening yen coming from the financial officials that said that rapid appreciation of yen since the end of last week reflects market speculation, and Japan's officials are ready to act if needed. With dollar hovering just below the 2 months lows at 80 yen, Finance Minister for International Affairs said that there is a need to be vigilant in the foreign exchange market to see if speculative moves are causing the yen's rise. Just reminder that last year the Japanese central bank acted 3 times in order to prevent further strengthening of the yen, and the last action was seen after the pair hit its fresh record low at 75.56. Shortly after that, that was the end of October 2011. The intervention pushed the pair's price to 79.50, and afterwards action from 76 base resulted in the recent strong rally that peaked at 84.17. Currently, the pullback is still seen corrective, but from some technical points of view, it seems that yen is again gaining strength, and most likely in the near future, the action of Japanese central bank will be required in order to prevent further strengthening of the local currency. From today's calendar, as said, today is the 1st of May, so a number of countries are celebrating as the Labor Day. As we can see on the calendar, from European countries, France, Italy, and Germany are off today for the holiday. Released figures, as already mentioned, 3.75 is the new interest rate for Aussie dollar, while Australian house price index quarterly for first quarter dropped significantly compared to the minus 0.3% forecast for today. It came in surprisingly minus 1.10%. Commodity prices in Australia also dropped significantly to minus 4.2% versus the 2.7% of the previous release of month of April. Still to come in a couple of minutes, we'll have UK's manufacturing PMI for April that is forecasted slightly lower from the previous release at 152.1. 51.4 is the forecast for today. Still holding the positive tone as holding above 50 level. However, a negative output for April might be signaling a further recession coming into your UK's economy. From Americas, at 1400 GMT, US manufacturing PMI for April is forecasted at 53, slightly below March's release at 53.4, while ISM manufacturing prices for April are also expected to come lower today. 59.2 is the forecast compared to 61 release. And the last one from states construction spending for March, improvement by 0.5% compared to the negative minus 1.10% of the previous release. A couple of speakers seen today. 16:30 GMT is the FOMC member Lockhart due to have a speech, and at 17:05 Bank of Canada Governor Carney is also due to speak. A quick look now at the markets. I would like to start with the Aussie dollar today, as this was the most significant move after the surprising action of Central Bank of Australia. As we can see, the Aussie dollar dropped significantly from levels above 104 after the news were released, dipping so far to 103.10 and basically threatening our main psychological support at 103.00 that the price is currently approaching, ahead of more significant levels at 102.45 and 102.46. This is, pardon, 102.45, which is approximately slightly below 50% of the broader up move from November 2011 96.62 low that peaked at 108.55 at the end of February 2012. Break below daily 200 days moving average might be signaling further weakness, yet we need to see break of 102.25 in order to confirm an open way for further extension and retracement, as the pair is from the beginning of April moving in the consolidative sideways mode, moving within the range of 102.25 and 104.70 with latest upside rejection just under 90 days moving average, and the subsequent slide after the data from Australian Central Bank now weakening the tone. Negative sentiment now pushes the price lower. We need to see the action at 102.25. In case of break here, we might see the price significantly lower, with the next static support at 101.44 and the 61.8% Fibonacci retracement. Quite significant support at 101.18. Loss of these levels would definitely push price towards the parity level, and the further retracement of the past few months rally from 96.62 to 108.55. On the upside, a regain of 104.50 and 104.80, which is recent range ceiling, is required to improve the outlook and confirm the base at 102.25 in order for a pair to regain strength and extend towards next static resistance at 105.56 and more significant 106.36. The euro-dollar holds its short-term positive tone of last Friday's low at 131.57. That subsequent rally higher peaked at 132.69. This is the fresh high, with yesterday's renewed attempt higher being rejected just few ticks below at 132.65. Dips lower found support at just above 132.00, our next support, and fresh strength is now underway, looking for a retest of 132.69, 132.65, with the more significant barrier seen on 132.90 that marks the main bear trend line drawn of 134.85 through 133.80, and 133.00 as a psychological and round figure barrier, and break above these levels is to open way for further recovery of recent base at 130.00. Better seen on the daily chart, as the pair is still within the range in past couple of months. The range is supported on the downside by 130.00 zone, and on the upside we have 133.80 and 134.85, which marks the top of the range. A break above 130 is to open towards next significant barrier, 133.80 zone, end of March 2012 highs, and above these levels we have a very significant barrier at 134.85, double top of end of February, as well as close to this level is 134.72, 200 days moving average. Situation on the daily chart shows the studies in a, I would say, sideways mode currently, but break above 133 is required to increase the speed of the current recovery, and brings a more positive tone into it. On the hourly, studies are now gaining momentum for possible attack at 132.69 and more significant barriers at 132.90 and 133.00. On the downside, yesterday's low at 132.00 offers good support ahead of 131.57 last Friday's low, and basically only break below this level, and 131.00 would further weaken the structure and signal further sideways movements within the recently previously mentioned range. The cable is in the near-term corrective mode after the latest rally of 160.80 base peaked at 163.00 yesterday. This was our initial target, psychological barrier and round figure resistance that was not cleared at the first attempt. Currently the pair after a brief consolidation at 162.20 zone that was hit yesterday. Brief consolidation was within narrow range of 20 pips. Followed, however, this morning's action has seen a brief break lower to 162.10. Still, this marks the previous peaks of 159. Anyway, we cannot find it now. Anyway, 162 now offers quite good support, and while holding above this level, also above just below this is 161.91, 50% retracement of the latest up leg. While holding here, immediate focus remains at the upside. Negative tone is still dominating on the hourly studies, while 4-hour ones are still holding above their midlines, but all pointing lower. That would be signal of possible further corrective action. So far, the 20 days exponential moving average contained dips, and ideally reversal here would be seen for a fresh attack higher. However, on the downside, still 162 and 161.52 low of last Friday are acting as next good supports, along with 161.40 55 days moving average, and the Fibonacci support at 161.15. I would say only loss of 161 level would delay the short-term bullish structure of 158.17 and allow for a deeper reversal. On the upside, break above 163.00 opens 163.88. That marks 76.4 Fibonacci retracement of the longer-term down move from 167.45 to 152.33, ahead of 164.00 as a round figure barrier. As mentioned at the beginning, the dollar-yen continues to head south. Loss of our initial supports 80.28, 80.09 and 80.00 resulted in fresh weakness that so far dipped to 79.63. This is just ahead of our post-intervention peak at 79.52, 30th of October 2011 high. That is our next target, along with the 79.72 currently 90 days moving average that has already been dented, and the break here is opening 79.52 as said, and then 79.00 1st of November high, and also around the figure support. Before this we have 79.13, 61.8% Fibonacci retracement of the rally from 76 to 84.17. Negative tone is seen on the daily chart and keeps the downside firmly in play, along with the hourly studies that are quite extended and signaling some corrective action. On the 4-hour chart, also similar situation. Very the studies are at their extreme points, yet no any signal of corrective action, but this might be signaling some bounce higher before the bears take control and push the pair lower. As mentioned, the comments from Bank of Japan officials, now the possible action of Bank of Japan is on the table, and we might be expecting them to act at any time. Usually they don't announce anything, so we have to keep an eye on this instrument. Whoever is trading the dollar yen has to be aware that possibility of intervention of Bank of Japan is quite high at this point. The dollar Swiss also is in the steady downtrend of 92.50, recent peak posted on 16th of April after losing a strong support zone at 91.00 and extending so far to 90.50. A brief consolidation was seen on above 90.50. This was the last Friday's low. That peaked at 90.95, just ahead of 91.00, and it was capped by the main bear trend line that keeps capping the upside from 92.50. Fresh weakness is now heading towards 90.50 as our next downside target, with the negative studies on 1 and 4 hour charts keeping the downside favored, with break below 90.50 to open way for the next pardon, a significant support at 90.00, ahead of a more significant and stronger one at 89.30, double bottom of end of February, as well as 200 days moving average that acts as a very strong support, and break below these levels would be signaling a further extension of the down move from beginning of the year top at 95.93 that so far hit 89.30 level. A quick look at gold, that is again now regaining strength after dipping down to 1612 and 1624, currently testing the bear trend line of 1725 pardon, at 1666, with the break here to expose 1675 90 days moving average, and the static barriers at 1680 and 1683, ahead of a very significant barrier at the 17 zone, where is the previous peak of 27th of March, and the 200 days moving average. Improving studies on the daily chart, however, still MACD is still holding below their below its midline, with momentum hovering around the midline, still keeping the downside vulnerable, and failure to break the trend line and lift significantly above these levels keeps the risk of a fresh slide and a possible test on the downside. Trend line support at 1634, ahead of lows at 1623 and 1612. On the near term, studies are more positive on the 4 hour and 1 hour chart, however losing traction at this point after being capped at 1668 might trigger some corrective action. It's important to hold above 1640-50 zone. That will keep the recent recovery in play. Otherwise, loss of 1644, 1640 would refocus levels at 1624 and 1612 as a low of 4th of April 2012. That was all for today. Thank you for attending our webinars. All those that connected later or missed the session can find it shortly uploaded in the YouTube Windsor's page called the Windsor Brokers Forex. We are back tomorrow morning at the same time at 7:00 GMT. I wish you a nice day. Thank you.